All right, so you want to dive into CFD trading. Ready to ride those profit waves, but, not get totally wiped out in the process.
Who doesn't, right?
That's what we're diving into today. We're using essential risk management tips for CFD trading as our guide.
Sounds like a plan.
So let's jump right in. First things first, how do the pros prevent those really awful, gut-wrenching losses?
Right. Well, the guide really emphasizes stop-loss orders. They're absolutely essential for CFD traders. Think of it like setting a line in the sand.
Oh, I like that. A point where you're willing to say, okay, I'm out, before things go totally south.
Precisely. You're protecting your capital. Now, the thing is, a lot of new traders, they base these stop-loss orders on their emotions. It's all fear and greed, you see. But using them effectively, that takes being a little more calculated.
So, no more panic selling when the market takes a little dip.
Exactly. The guide recommends actually, looking at the CFD's volatility. A CFD that's all over the place might need a wider stop-loss, something more stable, maybe a tighter one.
But that makes sense. You wouldn't want to get knocked out of a trade by a little blip, but you also don't want to be hanging on for dear life when it's really tanking.
Right. And here's another thing. You got to consider the type of CFD. A CFD on, say, oil, something really volatile. Well, it'll probably need a wider stop loss than a CFD that's tracking a really solid stock.
It's all about understanding what you're dealing with.
Right.
Okay, so we've talked about limiting losses, but what about locking in those profits? That's where take profit orders come in, yeah.
Exactly. Your stop loss is like your safety net, right? Well, a take profit order, that's your profit target. You set it to automatically exit a trade when your CFD hits a certain price. Locks in those gains, no second guessing, no letting greed get in the way.
Oh, I like that. No more staring at charts all day, just waiting for that perfect moment. So how did the pros decide on these take profit levels? Is there some sort of magic formula?
I wish it were that simple. The guide actually recommends considering your risk-reward ratio. Let's say you're aiming for a 2.1 risk-reward ratio. You're willing to risk $1 to potentially make $2, right? Well, your take-profit level should reflect that.
Okay, so there's some actual math involved, not just wishful thinking. This is good. I'm liking this whole having a system thing.
It's not just about throwing darts at a board. You've got to look at the bigger picture. Say you're trading a company's stock. Look at their recent earnings, maybe some analyst forecasts, any news that could impact the price.
You're using that to inform your profit target. So smart.
Precisely. You're basically saying, okay, if the market reacts well to this, I expect the CFD to move this much, and that's where I'll take my profit.
So we've got our safety net, our profit target. What's next?
Well, we can't forget about leverage, right?
Yes, leverage. It can be alluring and a little intimidating all at the same time.
Absolutely. It's powerful, a double-edged sword.
Okay, I'm intrigued. Tell me more.
The guide goes into detail about different leverage ratios and how they can really impact your risk, especially with different CFDs.
So it's not a one-size-fits-all approach?
Not at all. You could be trading, let's say, a really volatile index CFD with high leverage, even a small move in the market, and boom, huge gains or huge losses.
Yeah, that's what makes it a bit scary. So it's not just about picking a high leverage number and, crossing your fingers.
Nope. You've got to find that sweet spot, the balance between maximizing those returns and managing your risk, yourself, your risk tolerance, and the guide. It actually suggests starting a bit lower, especially when you're new to a CFD. As you get more comfortable, more experienced, then think about increasing the leverage.
So it's like learning to drive, right?
Yeah.
Start with something a bit more, shall we say, modest before you jump into a sports car. Get a feel for it.
Exactly. You need to be comfortable. And speaking of needing a steady hand, let's talk about economic announcements. Those unexpected events that can really shake things up.
Oh, tell me about it. It's like 1 minute everything is smooth sailing and the next, bam, market chaos. So how do we prepare for those curveballs? Give me your best tips.
Well, you don't want to be caught off guard, right? The guide talks about anticipating these announcements.
So like checking the economic calendar, keeping an eye on the news, all that.
Exactly. It's like checking the weather forecast before you head out. You want to know if there's a storm coming, right?
Right. But how does knowing about, say, an interest rate decision, how does that actually help me when I'm trading CFDs?
Okay, let's say you're trading a CFD on a currency pair, right? Big interest rate decision coming up. You might decide, okay, I'm going to reduce my position size or even close out completely before the announcement.
Kind of like batten down the hatches, wait for the storm to pass.
Exactly. But then again, some traders, they see this as an opportunity. Maybe they've got a specific strategy, something designed to take advantage of all that volatility.
So it's all about knowing your own risk tolerance, having a plan for Well, for all the different scenarios.
Right.
Yeah,
Exactly.
this is all making sense. But, we've covered a lot. Stop losses, take profits, leverage, economic announcements. It's a lot to keep track of. How do we avoid putting all our eggs in one basket? What does the guide say about diversification?
Well, it's not just about spreading your eggs around. It's about understanding what those baskets are made of, right?
Okay, I got that.
The guide actually talks about asset correlation.
Oh, yeah, I've heard of that, but to be honest, I'm a little fuzzy on the details.
Basically, it means that some assets, they tend to move in the same direction.
They move together.
Right. And others, well, when one zigs, the other zags.
Interesting. So you could diversify, but if you're not careful, you could end up worse off.
Exactly. Let's imagine you've got all your CFD trades in different stocks, but they're all in the same sector.
Okay, I see where you're going with this.
That sector takes a hit, and your whole portfolio is down.
Not good. So how do we avoid that? What's the smarter approach?
Diversify across different asset classes. Don't just stick to stock CFDs, maybe add some commodities, some index CFDs, even Forex. The key is to find things that have low or even negative correlation.
So some things go down, others go up. You're kind of balancing things out.
Precisely. You're building in that buffer. Reduces the impact of any single market move.
This is all great stuff. Okay, so let's say I've got my diversified portfolio, my stop losses, my take profits. I'm feeling pretty good about managing my risk. What else do I need to be thinking about?
This next part is really where the rubber meets the road. Position sizing and risk-reward ratios.
All right, lay it on me.
Because even if you do everything right, you're being careful, you're diversifying. If you risk a huge chunk of your capital on one single trade, one bad move, and you could be wiped out.
Yeah, that's the nightmare scenario, isn't it?
It's about finding that balance, risking enough to make it worth your while, but not so much that one loss takes you out of the game.
Right, makes sense. So what's the secret? How much should I be risking?
Well, of the guide, it actually recommends a general rule. Never risk more than 1-2% of your total trading capital on any single trade.
Okay, that seems like a pretty good rule of thumb. But how do you figure out how much of a CFD to actually buy or sell to stay within that limit? How does that work in practice?
That's where your stop loss comes in. Let's say you've got a $10,000 account. You're willing to risk 1% on a trade, so that's $100. Now you find a CFD and you've set your stop loss, let's just say 0 fall and 50 cents away from your entry price.
So if it moves against you by 50 cents, your stop loss kicks in, you're out, you lose that $100.
Exactly. So to stay within that risk limit, you need to calculate your position size. In this case, you would buy or sell 200 units of that CFD.
200 units times 50 cents, that's your $100 risk. Got it. My head's spinning a little, but I think I'm following along.
It might seem a bit complicated at first, but once you get it, it's like second nature, trust me.
I believe you. Okay, so we've covered managing the downside, but what about maximizing the wins? How does the risk-reward ratio play into this?
That's the name of the game, right? And remember, it's not just about winning trades. It's about making sure those wins are bigger than your losses. The guide suggests going for at least a 1.2 risk-reward ratio.
So for every dollar I risk, I'm aiming to make at least 2.
You got it. That way, even if you're only winning, let's say, half of your trades, you're still coming out ahead over time.
That makes a lot of sense. This is all starting to come together.
Yeah.
Okay, so we're being smart about our entry points, our exit points, our leverage, diversifying our CFDs, how much we're risking on each trade. What else can we do to kind of, be on track, make sure we're constantly improving, making smarter decisions? Any other nuggets of wisdom in this guide?
This next part is crucial, and it's often the thing that traders, they just don't do it. It's about learning, not just trading, but learning from every trade you make. And the guide, it really emphasizes the importance of keeping a trading journal.
A journal?
Yeah.
You mean like a diary, but for my CFD trades?
Exactly.
Tell me more. Why is that so important? So it's like we're not just clicking buttons and hoping for the best. We're analyzing our decisions, trying to understand what's behind them.
Exactly. Turning those gut feelings into, well, more calculated decisions. Think about it. When you place a trade, what's it based on? A hot tip you heard, some chart pattern you think you saw. Write it down. And then how'd you feel during that trade? Anxious, excited, like you could do no wrong? Write that down too.
Oh, interesting. So we're tracking our emotions as well. What else should we be putting in this trading journal?
The guide really stresses this. Document your entry and exit points, your risk management, everything. What was your thinking? Later on, you can go back and you can actually see what worked, what didn't, and most importantly, why.
So it's like, having a conversation with your past trading self.
Yeah.
learning from the mistakes and the successes. Now, that's what I call self-improvement.
Right. It's about taking those lessons and, actually putting them into practice. Maybe you'll realize, hey, every time there's a news release, I get all jumpy, start making impulsive trades, or I keep getting cold feet, exiting trades too early.
Oh, yeah. Those are some expensive lessons to learn.
Yeah.
Okay, we've talked about journaling. What about having a more, I don't know, structured plan right from the start? A trading plan. What does our guide have to say about that?
Think of your journal like your rearview mirror.
Right.
It shows you where you've been. But now imagine you're heading out on a road trip, no map, no destination in mind. That's trading without a plan.
Yeah, that asking for trouble. So how do we create a plan, a good one, that doesn't feel too, restrictive?
It starts with your goals and your risk tolerance. Are you mainly looking for some short-term income from your CFDs, or is this a long-term growth strategy? How much are you comfortable risking to reach those goals?
Right. Everyone's got different priorities, different comfort levels.
Exactly. The guide suggests you outline your whole trading strategy. Will you be using technical analysis, fundamental analysis, or a mix of both? What type of CFDs are you going to focus on? How will you know when to enter and exit trades?
It's like creating a roadmap for our CFD journey.
I like that. But it's not set in stone, right? Markets change, so should your plan. The guide says it's important to review it, refine it, based on how you're doing, what the market's doing.
So a balance between structure and flexibility.
Exactly. Have a direction, but be ready to adapt when you need to.
This has been an amazing deep dive. We've covered so much ground, all those essential risk management tools, the importance of a trading plan, and reflecting on our trades, learning from every single one. As we wrap up, what's the one key takeaway you want our listeners to remember?
That CFD trading, it's a marathon, not a sprint. It's about managing your risk, learning, adapting. If you can do those things consistently, you're giving yourself a real fighting chance.
It's about respecting the power of those markets, but also having the knowledge and the skills to navigate them safely. That's a wrap on our deep dive into the world of CFD trading. Until next time, happy trading, everyone. And remember, knowledge is power, especially when it comes to managing risk.